historical data is priced into the stock. That one's a little bit hard to prove because private information is not necessarily always available to everyone. But there are limitations to this. The super investors have shown that it is possible to consistently beat the market. I think this is mostly because individual investors value stocks differently, and they interpret the information available differently. So the intrinsic value to one person is going to be different to another, and that's going to make it hard to generate what an accurate market price should be. There's also lags between information and changes in the price, and oftentimes future expectations are factored into the price. So there is opportunities for investors to beat the market, as the super investors have shown. And also, it doesn't really take into effect, I think, of human error and bias. Basically, you're expecting people to behave rationally, but as people know, it's like, especially behavioral economics, people don't always behave rationally. So people are overinvesting in a sector, even though the information available shouldn't reflect that. That could drive a price up or down, and that would cause the value of the price to be differently or overvalued or undervalued, creating opportunities for higher gains. And then there's modern portfolio theory. It's a theory that tries to maximize the return on portfolios given a level of risk. Basically, it tries to show that investors can trade higher risk for higher returns. You try to create a diverse portfolio that will, so the goal is to try and create a portfolio that will give the highest possible return given the level of risk through a mix of assets such as stocks or bonds. And super investors have proven that they can generate higher returns with lower risk than some of the standard measures, showing that it's always basically through value investing, you can kind of beat modern portfolio theory. You don't necessarily have to trade higher risk to get a higher return. If you have stocks that are undervalued, or if you're investing in stocks at low prices, your risk is necessarily lower, and there's a possibility for higher gains. So it isn't necessarily a high risk equals high return. I think that sometimes there's a reverse correlation in that. So the efficient frontier, when I tried to calculate, it was my first time I was exposed to it. I couldn't really get the math to work out how I wanted. But efficient frontier is basically the set of portfolios that we attempt to maximize the return for a given level of risk. The risk-free rate is usually like a short-term U.S. Treasury bond, and the highest possible or the best possible portfolio would be the line of tangency from the capital allocation line to your efficient frontier. And so for my super investors index, the two I added on my own were Chuck Royce. When I looked up him, his company looks for small market companies that he basically believes are trading below true value. And I also looked up Ron Barron. He also likes to look at small and medium-sized companies using a value-based approach and growing companies. So I thought that they kind of combined value and growth investing into it, but specifically also looked at small market companies. And before I keep going, is there any questions?
No questions yet.
Okay. So this is the 20-year annual returns. So I graphed the S&P 500, Russell 2000, and my super investor index. And the average returns for the super investor index were higher. For annual returns, though, it wasn't necessarily like they were always beating them or way up above the two main index, but the volatility was the lowest for them. But so basically when things crashed, they usually didn't crash as much. But that does say, like for annualized returns, I didn't see that it was consistently across the board, even though the average returns were the highest for the super investor index. And so for 5-year rolling returns, the super investor index after the year 2000 did have the highest 5-year rolling returns for every year after that. The Russell 2000 had the lowest volatility, which I found interesting. basically because that kind of contrasted with what the research was saying previously, where it said that small cap indexes are usually more volatile. So I wasn't really sure what the reason for that was, but it's slightly lower than the super investor index for the 5-year rolling. For the 10-year rolling, the super investor index was consistently higher than the S&P and Russell 2000. Once again, I thought it was interesting to note that the Russell 2000 had the lowest volatility, but it did also have had lower returns than the super investor index, suggesting that maybe modern portfolio theory does have a place where they have lower risk, but they also have lower returns than the super investors.